All right, so stocks continued their slide here today. A nice little rebound at the end, but for the most part, continued their slide into today. So, then, of course, the question that remains is, are we on a renewed intermediate decline? Aren't we supposed to be kind of bullish now? We're supposed to kind of bounce off of this. That's what we've been hearing. We've had our typical August seasonal low, and we're bouncing off of this to new highs. And a lot of people telling us how this September could be really bullish. So how bearish is this past few days, and how likely are we to continue that to the downside, or are we just going to continue to bounce back up and actually have that bullish September? So I'm going to break down some of the moves that we're seeing here, especially in the different asset classes, and some very interesting long-term patterns that suggest that maybe this move isn't done, that we might just be kind of in the beginning stages of what might ultimately turn into another correction. Similar to what we've seen really multiple times since that fourth quarter 2018. They've been coming in rapid succession here. So we're going to talk about why I say that, what the pattern looks like, and what we're seeing right now that would suggest that might be where we're headed. Of course, taking a look at different sector moves to support and see if there's anything going on there that tells us something. There is some interesting patterns there too. And our trade idea today is a stock that looks very much like the S&P 500 and more so maybe like the Russell 2000, and is giving us a bearish trade signal right now. We'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, September the 6th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our website, check out some of these other things on the right, including our Market Outlook live video I do at 3:30 Eastern time here before the market closes. Come down to the bottom, click this heart. It opens up this tab. Click that like button. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to more of our followers on those platforms. Our goal is always get to 100, and we're getting closer and closer on my videos there. It looks like you're getting there on Brandon's video, so let's see if we can get there on mine as well. So thank you to those of you who like these day in and day out, and those who don't. You can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we continue our decline. So we've had 4 days in a row. 3 out of 4 were down. 4 days in a row where we closed lower than where we opened. So we went down at least during the day. And as a result, it's brought short-term sentiment down to bearish levels. The momentum line hit extreme lows yesterday. Stayed in bearish territory, barely above the reversal zone because of the rally off the lows today. And then, of course, the near-term line did drop well into the reversal zone here after having crossed below the intermediate line that we were talking about in our last market outlook video. So we are back below the moving average by about 0.25%. So we have light pink shading in a red line. You don't get the dark pink until the intermediate line gets back below 50. But if this ends up being a peak for the intermediate line below market sentiment, no less, then that would be a pretty bearish intermediate peak to get into bullish territory barely, and then not be able to cross above market sentiment, not be able to get into the upper reversal zone, right, and really get things started for a new intermediate run. So it'd be more bearish than if we would have just, actually had an intermediate pullback here and not just this little, not even 5% drop, which, had a lot of people saying, oh, this is very typical pullback. And the reality is it was very weak. It was one of your weaker pullbacks that we have seen in quite some time. So again, had to go all the way back to November 2016 to have a weaker pullback, but we came out of that with some, with the election, which provided a lot of fiscal stimulus to the markets, considering the potential regulation, fiscal policies that were expected to be put in place that were obviously pro-business and had a big bullish impact on the markets in 2017. So that was the last time we had that week. We don't have the same kind of stimulative package. I mean, there's not going to be any fiscal policies put in place right now to stimulate the economy. Not with the Congress, not being held by the same party. We're not going to have any monetary stimulus as we are in tightening mode with interest rates as well as the balance sheet. So a much different environment, which makes it seem not very plausible that we'd have that small of a decline and not continue it, right? Which is what we've been talking about for some time here. That's the S&P 500. If you take a look at the NASDAQ, which has been the most bullish, it actually had a bigger decline today. So its short-term sentiment is stayed away from being at extremes. We're still above the moving average by less than 1%. The intermediate line is trying to get above market sentiment, but obviously has really slowed down. So really important to see how the NASDAQ 100 follows up on this. Whether or not we actually get another bull tag, right, where we get light pink shading coming from the intermediate line dropping below 80, but above 50, and then a yellow line because we would be below a rising moving average, depending upon if it's still rising by then. So that's the NASDAQ 100. The Russell 2000, we talked about that bear tag being potentially a bounce bear tag, and boy howdy was it yesterday. A bounce bear tag with that drop. We talked about that in our class here. We followed through with that, so short-term sentiment is very bearish. The intermediate line didn't even get to the bullish territory. It's actually still in bearish territory, well below market sentiment. We're back to dark pink shading and a red line just like that. So pretty bearish for the Russell 2000. And then, of course, when you look at the Dow Jones Industrial Average, you can see, again, it's also back to dark pink shading and a red line. Never did get above the moving average. Didn't even get the bear tag at all because we never did close above the moving average at all. And we're already back to 1.4% below and flirting with getting back into bearish territory in this intermediate line with short-term sentiment at bearish levels. So you can see how we're like the market forecast is suggesting that this little strength that we've had at the end of August, beginning of September was not a whole lot. Nothing that we were too concerned with. We were still expecting more bearishness here. At least I was, and we're seeing that. We're seeing some more weakness here in the past few days, and of course you have to get for it to really matter. I mean, 1 or 2 days is just noise. So for it to really matter, you got to start to close. We got to get a bearish candle here. Get that Hakunashi candle below 0. Get it back below its average. It is a very weak positive level candle. Some of these other instances where we did turn positive only to turn back down on these failed rallies, they got a lot higher. Like this one here in May got it got up to 2.3%. The body was a lot bigger than what we saw right now. So and you got the green arrow last week. If we end up this week finishing with the red arrow, especially if we already have a lower high point. If we end up with a lower close or more of a transition candle, then you would expect that would turn into a bearish week for next week. Again, you look at the Russell 2000. Look at the Russell 2000 here. We do have that set up, right? So we do have, again, the red arrow again and another transition. So we didn't turn back up. We're actually kind of coming back down with the candles, even smaller positive candles than what we have in the S&P 500. Now let's look at the 3 green arrow charts. So we did get, we don't have 3 green arrows anymore on the S&P. We do still on the NASDAQ because it's still above its moving average. MACD and stochastics are rolling over. On the diamonds and the Russell, because the stochastics never got in the reversal zone, their turning over has already produced red arrows there, and the MACDs are pretty close, the Dow especially, to getting that 3rd red arrow again. So one day of 3 green arrows, I mean, that's about as picture perfect of an example of what happens when you get that bounce bear in this case the bounce bear tag, just like these bounce bull tags work out to be pretty positive there on that 3 red arrow that we had briefly for 1 day on the diamonds over there. When they bounce right back up, then it's a pretty good sign that that's going to hold. So that's why 3 red arrows are a really good bullish signal. 3 green arrows can be a really good bearish signal, because you'll know right away if it's not going to work, because it will just keep going, like the 3 red arrows you got here or the 3 red arrows you got there. You know right away if it's not going to work. And if it does work, it typically produces a pretty decent move. In this case, you would expect this to go, to much lower lows than what we had on this first instance here. So that's kind of how. And keep in mind, though, if we do get a little bit more bearish on the S&P 500, you still have some very significant resistance from a Fibonacci standpoint, not from a volume standpoint, but from a Fibonacci standpoint here at 4,300. Again, coming off of a lower high point and a bearish intermediate peak, you probably expect that we would get below that. So that puts 4,200 into play with all the Fibonacci levels, multiple touches here, and maybe a little bit below that down to this 50% retracement. So, and the old February peak, in addition to, see, that old August peak from the Jackson Hole event is actually at that 4,300 level. So you break into that, and you can see there's a lot of touches right around 4,200 plus or minus a few points. So that's kind of where you would expect resistance ultimately, or support ultimately, for the markets to find some support if we do turn out to be more bearish than what we saw going into that August expiration date. Looking at the 2-line version of this chart, so we got below the 30-day moving average on the S&P. We were flirting with the 17 and the 50-day as well. So we're still well above the value area. So there's still not a whole lot of support up here, or resistance for that matter. But there's not a whole lot of support here. So it's very easy for it to come down to this 4,200 layer, where the top of the value area is, where the 200-day moving average would be by the time we did get down there. So there's going to be a lot of support in that area as you see MACD and stochastic indicators falling back down. Still above the moving averages, but rolling back down towards those moving averages there. Looking at some of these other oscillators, on the DMI, you can see the negative indicator bouncing back up, but the positive is still right there at 25 as well. In fact, they're both kind of sitting right on top of each other. That makes the ADX continue to falter, so we still don't have a trend established here. You see that on the Ichimoku cloud as well. I mean, we're starting to pick up the a little bit of a bearish, but it's got to get below -1. It's got to get above 50, and you're not quite there yet. And of course, if we're going to have a continuation of this intermediate decline, then you got to get back to this intermediate trend strength at least for that to happen. You are in the cloud, so we didn't stay above the cloud. We have a negative rate of change. It appears that will most likely stay the case unless we can really bounce up here sharply. We are still above the blue and the green line, so keep an eye on that, and keep an eye on that cloud, the bottom of this cloud, for an area of support for this stock, as well as this pink area here. Again, very important by the time we get to it that we are trading above it for the trend to stay bullish. Because if we're trading below it, as we've seen in the past, that's a pretty good sign of that we're in correction mode. So the longer we trade below it, if and when we do get down there, and you can see, like from IWM, we are below now. So the more we stay below it here without getting back up to, in this case, above 190, then the more likely we will be there by the time we get there. So that's kind of very strong negative rate of change on the Russell as well. And again, back to the bottom of the cloud, which had acted as support already once. And we'll see if it acts as support again this second go around. Looking at the RSI and the CCI, you can see we're flirting with getting back below 50 and below 0 on both of these indicators. So we weren't able to change this to green because we never did solidify it with a move above 60 to help confirm that CCI move. So again, watch for the CCI to break back down below -100, which would confirm that we're still in kind of bearish mode on this trend here, and 4,400 would be probably is not going to offer a whole lot of support at all for us if we were to work our way back down into the lowest quartile, the lower half of the bandwidth, and ultimately into the lowest quartile. We're still kind of right at the midpoint today, and we still have positive momentum, and with green dots. So we had the change from green to red to green with a change in momentum there. But again, if we continue into the lower half of this chart, that's probably also going to be short-lived too, and that's kind of my expectation. Looking at today's range, you can see after getting a new high and breaking out on Friday, boy, we have not been able to follow up with another new high, have we? So the Arun indicator hit to 100 but only stayed for like a day. That would not be a good sign if it were to already drop below 70 after only spending a day up there. So we did jump back up to the point of control for the 4-week. We did hold the midpoint of the 4-week range. So those are some areas to keep an eye on. But again, the more this high tag moves over here, then the more likely we're going to get a new low point before we get a new high point. Right now, you would guess a new high point because we're closer to it. But again, if we follow through with some of this weakness here in the next day or two, by the time we get to the weekend, then that will make it more likely that we get kind of this really bearish pattern where, like I said, only spending a day up here. I mean, you see it's not common for us to get that break above 100 and only spend like a single day. Every other time we got into new 4-week highs, we were able to hold it, except for over here, which you can see in multiple instances. Let's go back out 10 years. In the fourth quarter of 2018, multiple instances here. First, it was in September when we had that peak right there. And then we still kind of were grinding higher. Then we had, the beginning of a pullback, failed pullback bounce. I got you to 1 day of a new high point, and then the continuation, the failure of that pullback bounce, and then, ultimately this was a correction because we got all the way down to the 200-week moving average. So, again, that's kind of what we're looking at here. A pullback, as weak as it was, a failed pullback bounce, with only 1 day, then that would suggest the failure of this pullback bounce leading to the beginning of actual correction mode. From a breadth standpoint, we were already down to pretty negative breadth here, already at -10. So we've already flipped from relatively strong to negative. We were barely above zero to begin with. So if we were to get back below -35, the summation is going to turn negative very quickly. But then if you look at some of the other breadth indicators, like the new highs and new lows index that we check out, we'll come back to this one here in just a minute, that never did get above 100. Well, it's already back down below its moving average, which is, down there right around 150. We're at -200. I mean, that's a shift, a pretty significant shift in sentiment as we were above the moving average for a few days. But failing there, again, if you were to go back out to that, that 2018 when we were in that correction mode here, you can see it did get above its moving average, got all the way up to zero before failing back below its moving average, and the correction started. And we saw that as well here at the beginning of 2022, and even here in March with that failed pullback bounce there, where it turned slightly positive before falling down. So again, this is very typical of a failed pullback bounce where you get positive breadth, very weak positive breadth, and it fails and we turn back down. Remember, the number here for corrections is 150. We're already at 177, well below the moving average. The number on the 200-day is below 250, and we're already at 263. So that, getting below those levels and obviously staying below that is a sign of correction, right? Especially after a failed pullback bounce that only got this up to the moving average instead of above it like some of these others bounces did after pullbacks. It got easily back above the moving average and trended higher. This one got to the moving average and failed. So again, dropping below 250 after that would not be the good sign. So those are some really important indicators, again, to watch from a breadth standpoint over the next few days as the breadth appears to be deteriorating here. Volatility is also an important aspect. It's still really, really low. In fact, we dropped back down. We hit 15. We came back down. We're still closer to 85% than we are 90%. So it's very low despite a significant increase in the VVIX. Remember we talked about last week when the VVIX dropped below 80, that usually sets up for a jump in the VVIX, and considering its positive correlation would set up a jump in both these indicators. But when you look at the VIX and It's not just low relative to the VIX 3M. It's not just low relative to where VVIX says it should be, but it's also low relative to its average values with the MACD and stochastics turning up. So we are getting a kind of a change in sentiment here from a volatility standpoint, and it's still really in the infancy stages. It's still really low. Like, we went way too low on this pullback in volatility, and it's, like I said before, with the VVIX dropping as extremely low as it did, it's setting us up for quite the tsunami, the volatility tsunami that they talk about, where volatility just ramps up rapidly, quickly, up above the 200-day moving average, up above the at least up to the 100%, if not generally above it to the 105% mark, which would be a significant rise, and obviously get the VVIX up to relatively high levels. Those are all very typical of intermediate declines that we didn't even come close to seeing here previously, that you would expect that we would see now because of how extreme we got on at a low level of volatility essentially going into Friday's close. All right, now let's take a look at what's driving this price action today. So let's look at the asset class comparison chart, which you can see commodities are just killing it over the last 3 months, and so are yields continuing their strong rally. But if you take a look at just today alone, so we'll come out to September and we'll go to the 6th, then we'll look at the week so far. You can see that today it was a risk-off day, and it was the three-headed monster showed up, right? Bullish commodities, bullish, actually two of the three heads, bullish dollar, relatively bullish dollar. It was barely up on an absolute basis, but obviously outperforming these other asset classes. And then bond yields were actually not up, at least on the longest end. TLT, remember, is 20 to 30 years. So that the bonds were actually up today. But that's been the three-headed monster, right? If you look at the 10-year yield, bring it up here. There we go. It was up, a couple basis points and continued higher. MACD and stochastics are turning up, suggesting we might get some more of a run as we got that bull tag on the market forecast of 3 red arrows, and then, of course, the subsequent immediate bounce back up there. Commodities, of course, has been continuing its run higher, especially crude oil. If you look at the strong move in crude oil, this is continuing to push above $87. 85 was an important level as you zoom out here. 85 is where this Fibonacci resist or support is. If I were to draw this, turn this around, so let's turn this around here and draw it from the pullback that you had here all the way down to the decline. We won't necessarily use this long lower shadow, but kind of keep it in this area. You can see again, this is an important level to break through. This 38% Fibonacci retracement. Go back to the 1-year chart. We are above the value area. We're above the point of control. The 50-day is crossed above the 200-day. So we are now in golden cross environment. So when you look at the 10 and 40 week moving averages in conjunction with each other, eventually when it comes up here, you can see we have green shading and some pretty bullish candles. That's a relatively decent sized bullish candle there, closing above last week's high point. So very bullish from that as of right now. We still got 2 more days left, but very bullish candle there. Like I said, last time we had this golden crossover was back here at the end of 2020, and we know how long that lasted. And there's been fits and starts before of green, but generally when you get these crossovers, they can last for a while, and we'll see if that remains to be the case here. As like I said, we've got the green arrow already above the 10 week, nowhere near a red arrow yet, and a pretty bullish candle. So it suggests that might continue to be the case. The same thing is going on the 10-year yield, as we had a potential reversal last week. Never did get the red arrow, and we're back up with a higher close. We're not back up above this close yet, which would nullify the potential reversal there. So, but obviously you are in this golden cross environment with a PPO that's rising, and of course the dollar index, which has been quietly making some noise. Well, its 50-day or 10-week moving average, exponential moving average, is crossing above the 40-week this week with a strong bullish candle that's closing above multiple weeks highs. So very bullish week here for the dollar as it tries to get above an important Fibonacci retracement level as well, this 105 area, which is this bullish run that we've been retracing, and we get back above this resistance and make our way potentially back up towards 108. And like I said, the golden cross environment can take a while, especially when you're getting some pretty strong bullish candles there. And the last thing I think the stock market wants to see is a strengthening dollar, because that's not just, I mean, if you go back some time here, this is one of the stronger levels in the past 20 years, higher than any of these other instances, and not as high as we were in 2022, but as on a before that, it would be higher than any of these other instances here. If we were to go back as far back as we can go, we'd have to go all the way back out to 2003 when we were on our way back down from a very high level. During the bear market. See, when the bear market came, we were also in this 115 plus area, and again, could that be where we're going again as we head into a correction phase of potential bear market here in 2024, 2025? So with the potential golden cross, it suggests that we might be bullish for a while on the dollar index, especially if we continue to get these strong bullish candles here. If you take a look at how the sectors have performed here today, let's take a look at the 12 grid first, and then we'll look at that. You can see across the top we're still kind of light, dark green shading, and still kind of bullish. Energy is just killing it. But remember, energy is killing it. That hasn't been bullish for the markets. It's actually been, the best year energy's had here lately was 2022. So it's not the best sign for energy to be killing it, especially relative to everybody else. But look at everything else. Industrials, financials, materials, all the safe haven areas, all dark pink shading and red lines already. So, this is, we have more sectors in bear mode than we do in bullish mode right now. And then now if you look at the comparison chart, which you can see just how much energy is killing it over the past 3 months here. But if you just look at today and how utilities is just getting hammered. But looking at today, utilities is up, along with real estate and staples. Energy is up too. Again, it's behaving more like a safe haven. And then, of course, two of your big three are leading the gain or the losses to the downside. If you go out to the last 2 days here, then you can see materials and industrials had such a bad day yesterday. They didn't gain enough today to offset that loss, and they're still kind of at bearish levels. And these three sectors, which were so bullish yesterday, now coming back and kind of falling back down to earth, as we weren't nearly as bullish yesterday as maybe we thought we were. For our trade idea of the day, I wanted to take a look at Skyworks. And in our Market Outlook live video that I do at 3:30 Eastern Time, we did put on multiple trades today. So this is just one example of the trades, but we managed some of the existing trades that we've done in previous Market Outlook videos, and that's what we do in those live videos there. So in addition to putting on today's, which like I said is on Skyworks, you can kind of see is looking kind of like the market, where it looked like we were going to be bullish, we got the bear tag, and then boom, big reversal back down to the downside, dark pink shading and a red line already. I tried to get the 3 green arrows going. It did not work out. Right, we got the 3 green arrows. It lasted for 2 days. We're already back to at least 1 red arrow. Do same thing on that weekly chart with the candle there. We had the green arrow on the 10-week moving average last week, looking like we might transition to something more bullish. We are back to, we have a transition again, but we have the red arrow now, and again flirting with a death cross here of the 50 crossing down below the 200 day. Looking at the 2-line versions of the 3 green arrow is also, you can kind of see how significant that is. We failed at a very important resistance level with all this volume up here, as well as at the 50-day moving average. And we crashed back down below the 30 and the 17 and the 8, and even flirted with getting below the 200 today. MACD and stochastics rolling down, and not very much volume support down below the 200 as you work your way down towards the bottom of the value area, which is around 91, 95. Looking at some of these other oscillators, you can see The DMI is a pretty decent jump on the negative indicator with the positive already negative and staying negative. So potentially getting back to a bearish pattern there. You are on the cloud, you can see you are floating. We already got to the bottom of the cloud once and held, and we're floating with getting back below it again, back below the green line. The rate of change is negative, with the indicators down here suggesting we're pointing towards a renewed bearish trend. Looking at the RSI and the CCI, again, a failure to get to bullish levels. You got above the midpoints, but weren't able to get, the CCI got to strong bullish levels, but failed to confirm with the RSI, and you're already back to negative levels. You would expect we get to lower lows coming off of an easy lower high point there. The intermediate line, like the S&P 500 on the market forecast, got up to pretty decent levels, got up to the midpoint here, got out of bearish territory, and now is potentially falling back in with short-term sentiment looking as bad as it is. And then finally on the Bollinger Bands and the Keltner channel here, the bands have been inside the Keltner channels for a while, as we weren't able to get a good strong bullish move going and get the transition from bullish to from bearish to bullish with the green dots, with new green dots. And it looks like the other way, we're back in the lower half of the chart floating with the lowest quartile, and we might we might push on this lower end before we push on the upper end with a renewed bearish momentum. You can see the bullish momentum was very weak, and you wouldn't expect it would stay up there for very long. So what we decided to do on this trade was to do a long put vertical spread. So buy right around the low 20s, a pretty aggressive long put vertical spread. Here, let's put on the single symbol with again our same $500 risk. Going down to about 97.5 gets us more than the 3-to-1 reward to risk ratio. Remember, I told you 97.5 is in this area. 95 is one standard deviation, but you notice there's no volume in here, so it's going to be very easy for it to move all the way down towards 92, 91, plus or minus a dollar or two as you move towards that volume node, if it were to fill in that gap. Which, when you look at the moving averages, you are already below the 50, and you're flirting with getting below the 200. There wouldn't be a lot of support from a moving average standpoint either for the stock. It'd be very easy to fall inside of this gap, which is why I'm a little bit more aggressive than normal on the reward to risk ratio. The nice thing is the higher the reward to risk ratio, the lower the risk. So it's a low probability trade, but low probability trades have very low risk, and so that's what I like whenever I'm trying to speculate on a directional move. As significant as this. I mean, it's not the most significant move. It's a pretty straight. It's well within one standard deviation, so it's not full on like totally directional. But there's a pretty decent move. It would have to make a pretty decent move, and so I'm going to be well rewarded for that and not have to take much risk at all to be able to get that reward. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Follow and like us on Twitter and Facebook as well. Join our website at marketscholars.com for free. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.